So you see support for the S&P at around 2100. What do you do as an investor at the moment? Because there's increasingly people who are sidelining themselves, holding more in cash. Cash is king. Just because there is a market doesn't mean you have to invest in it. What's the right balance of being opportunistic but frightened, I guess?
Yeah, well, look, can the market break through 2,400? Absolutely. We are going to get so much bad news over the next 2 to 4 weeks that, 2,400 is the first support, but we've already broken that once. Could we break it again? Absolutely. 2,100 is critical support because that was resistance all through 2015 and 2016. We just couldn't get through it on the way up. It's going to be very powerful support on the way down. I would be very shocked with all the money and all the stimulus being thrown at the economy if we broke 2,100. So I think what investors ought to be thinking about, and what I'm personally doing in our portfolios, is I'm thinking about what's happening 12, 18, 24 months out. And I think with all this stimulus money, with $3 trillion that's going to be pushed into the economy, that's a lot of money that's going to be looking for a home. And I think that if you can take that longer view, there's a lot of support for equity prices once we get through what will undoubtedly be an awful lot of bad news.
Yeah.
And look at your alternatives. Bonds yield next to nothing. So it feels like when everything else looks ridiculously expensive, then stocks must be relatively cheap, and I think they are. And I think in a world of modern monetary theory, you want assets where their cash flows, their earnings can scale with the amount of money that's being injected into the economy, and that means equities.
Michael, I want to fold that over, though, into the concept that smart money is in bonds. If that's the case, investors just put in a record $7 billion of inflows into U.S. high-grade bond funds, high-yield bond funds this week. Does that tell you that the worst is over?
I think normally credit spreads start tightening before equities get serious about rallying. So I agree with your assessment of bond investors. As those credit spreads, and particularly on high yield, we should recognize there is going to be a default cycle in high yield. And I would say, if you look at the amount, typically there's 8 to 10 years between big default cycles, because we clean out the weak companies and then we overlend to them after about 8 to 10 years, and there's more weak companies to clean out. We have a very large pile of weak companies that are going to have to be cleaned out of the high yield pool, and defaults will probably hit 10% over the next 12 to 18 months. Having said that, that is well priced in right now given what historical recovery rates have been, and as you note, smart money is starting to sniff a bargain. High yield turns, investment grade turns, then equities turn. I think you're exactly right in terms of what that signals for the future for equity investors.
Our thank you there to Caravel Concepts Chairman and CEO Michael Jones. Not in the high